While tight fundamentals supported oil prices through mid-May, an escalating trade war and weaker activity indicators have finally caught up with the oil market sentiments. To talk more on this and to give the future outlook on crude and other related products, joining us now is Kang Wu, Head of Analytics Asia of S&P Global Platts. So, sir, to start off with, the US-China trade war has been the highlight and has been impacting crude prices of late. But how do you see the continuing trade war to impact the Brent crude prices going forward?
I think the U.S.-China trade war right now is one of the most bearish factors behind the oil prices and the oil market. People worry about the repercussions of the trade war on the economy. Indeed, the impact has been felt already, at least on the part of China. So since early this year, not only the overall state of the economy in China is weakening, the trade, particularly on the finished products. We talk about the chemicals and all the consumer goods and exports from China to the U.S. has been slowing down. There is uncertainties, of course. Towards the end of the month, there might be opportunities for the President Xi Jinping and President Donald Trump, to meet each other at G20 in Osaka. So that is one closely watched event. But overall, the situation is not very optimistic. The impact will continue to be felt through the economy in China, and so that is one of the factors now why people are very concerned with the state of the economy, leading to the bearish sentiment in the market at this moment regarding commodities, including energy and oil.
Okay. Now, Brent crude has come down from its highs of around $75 per barrel, but where do you expect crude prices to find support going forward?
Yeah, in terms of fundamentals, this year is two parallel developments. So we already talked about the demand and concern and the state of the economy. Actually, on the supply side, there are supposed to be concerns as well. With the end of the sanction waivers by the U.S. on Iran exports, the volumes of Iran exports have gone down substantially from April to May and June, and that will continue into the rest of the year. And on the demand side, we are in the driving season already, and the driving season will intensify from here moving forward for the next month and two. So with this, the market, with a huge withdrawal of the Iranian and the Venezuelan crudes and the driving season, plus the returning of the refineries from the historically high maintenance in May back to operations one by one in June and July. The demand is being built up. So from both supply and demand fundamentals, the market is getting tighter. That's even before any real impact of IMO 2020. So going through the summer, we see a little tighter supply overall of the oil market.
But then where do you expect the crude prices to remain? If you could give us some range, what your expectations are?
Yeah, in a very short term, for next month and August, for this period of time, seasonal factors play a big role. The demand and the seasonal demand and requiring supply. While when the requirement is high, there is the Iranian crude oil being out of the market. With this kind of development, we see support for the prices. So we are saying that for instance, for July, we see that oil prices will return to above 65 if all this play out, and then more like in latter part of the 60s. Not quite on the $70 yet, but getting towards that direction. And then later means like around September, October, when traditionally there will be a seasonal kind of ease of the demand. Then here comes the direct impact of IMO 2020 when the industry's market players are preparing for physically preparing for the incoming IMO 2020, January 1st, 2020. So that will provide the unusual sort of support for the oil prices. So preventing oil prices from going down. Instead, oil prices will further go up towards the end of the year rather than seasonally going down, because it's a very unprecedented development of the regulatory change of the sulfur content for the bunker fuel.
So despite the slowdown and the excess inventory that is there in the market, you're expecting crude to remain at least above $60. That is what I could understand from what you just said.
Well, I would say that will even go higher. So once you move past 65, moving towards close to 70, with the support of IMO 2020, in particular, we are talking about Brent crude prices. So that's very important indicator. So we're all talking about Brent crude prices here. So they're going to move past $70. Towards the end of the year, we're seeing past $75 with a strong support of IMO-related developments and the stronger demand for sweet crudes to be able to produce 0.5% low sulfur fuel oil or additional gas oil as a replacement for the massive amount of high sulfur fuel oil. Yeah, so it will be even higher towards the end of the year after the summer season.
Okay. Lastly, related to crude, what will be the key data point that you'll be watching out for the rest of the year and for the start of the first 3 months of 2020?
Well, the key is actually two key points on the crude oil side. Is really to see short-term the seasonal factors, how strong the demand is, and how on the supply side, how OPEC reacts to the demand. Now OPEC very much influenced by prices, particularly when we talk about U.S. supply. So that's on the seasonal side. Towards the end of the year, we'll see how the industry are preparing to provide the needed low sulfur 0.5% marine fuels or low sulfur fuel oil, and whether they are well prepared, which means prevent the gas oil prices from going too high, or they are based on our review that there will be enough volume. However, the gas oil price needs to go notably higher to incentivize the industry to get that ready. So it's overall seasonal demand, OPEC reactions, and readiness of the IMO, and how people start preparing for IMO 2020 spec change are all fields areas to watch. On top of that, of course, you still keep an eye closely on the demand side to see if there is any possibility of a trade deal being at least preliminary being reached or not. And demand, of course, sweetening. If the demand is weak, everything will go the other side. But oil price may react, which means lower prices. So far, our reference or base case still pointing to increasing tightness of the oil market with downside risk of the demand, which may driving prices of oil low. We'll continue to watch this.
Okay. Now, so far, because of a weaker demand, the Singapore gross refining margins have remained weak. But then going forward, other than the implementation of IMO 2020, which are expected to boost the gross refining margins, do you see any other key trigger points for the gross refining margins to be higher?
Yeah, you mentioned a very good point already. The IMO 2020 definitely will influence the margin, but that is more like starting from September, October. In the short term, the support, any support of the refining margin in Singapore will still come from the seasonal. Seasonal means a higher demand for gasoline and potentially higher margin for gasoline. So gasoline seasonally will continue to improve. And naphtha is being being weak, and it indirectly will benefit from the gasoline strength a little bit. For the short term, the support mainly come from gasoline, which is being low already. So any increase of gasoline margin, crack margin, and a little bit in recovery of naphtha seasonally will help the overall gross refining margin, while the gas oil is still pretty still on the state of the little change. But towards the end of the year is IMO 2020. That's where in the chain effects start from gas oil indirectly to gasoline and naphtha. But of course, number one is still gas oil will get supported because of the share demand coming up towards January 2020.
Okay. Now, LNG demand in the key consuming nations have rebounded in April, but still the gas prices in Asia have continued to remain weak. What would you attribute this to? Is oversupply the only reason behind this lower Singapore gas prices?
You're talking natural gas, right?
Yeah, liquefied natural gas, LNG.
Or is you talk about gasoline, gas oil?
No, liquefied natural gas.
Oh,
LNG,
yes,
right?
thank you. Yeah, liquefied natural gas. Yeah, the LNG indeed is very unusual, and of course there is factors behind it. First 4 months, LNG demand in Asia has been seasonally has been kind of on an annual basis lower than previous years. That leading to some of the cargoes moving towards Europe. Factors are many in Japan and in Korea, nuclear restart, and the weather and oil storage, and China, the state of the economy. Towards for the rest of the year, things will get a little better for the demand. Seasonal is another reason toward the winter time. But before things getting better, we'll continue to see JKM, which is the benchmark price for spot market in Asia, run by S&P Global Platts. We see that the JKM will be kept low for a few more months before it's getting better. We do continue to see that there is decoupling of JKM spot market price versus oil-linked prices for a period of time over the coming months and year and two. That will continue to happen because gas market is globally and also Asia now has entered their own sort of bit life of their own sort of development, rather than the traditional link to the oil prices.
But then what is the factor that is keeping the gas prices lower currently?
Well, the current low prices, there are majorly two reasons. Because overall demand is weak, so that's the number one reason. I mentioned Korea and Japan, nuclear restart offsetting some of the gas demand. China is not in a good shape in terms of the state of the economy, and you can also say that the U.S.-China trade war affect the sentiment in not just sentiment, the economy in China. So that's number one. And number two is also because Asia, once you have the weak demand, and then the issue of the oil indexed contract will play a role. So when you have so much oil index contract already, when the demand is weak, even with some adjustment, you still have an obligation to lift the oil index prices, which is much higher than JKM. So that's so. In other words, Asian economies cannot fully take advantage of the low JKM price. So they cannot bid up the price right away because their demand not only a bit weak, they are also being satisfied by existing long-term contracts. So that will improve. That will stay for a while. So keep JKM price low, and improve towards the winter time. So that will be more volume to trade and demand seasonally in North Asia.
So specifically to India now, despite this lower gas prices, the consumption in India has continued to remain weak. Do you expect this to change anytime soon?
That's a very good question for India. We are sitting here. India ought to take advantage of this environment. But just like any other Asian country, but India probably in particular, there is two issues and continue. Two or three. One is still the contract that India signed and maybe renegotiated, but there is a contract. And there is a domestic pricing system that in place in India that will have some add-ons to the price imported. And overall, of course, there is other structural issue which is not solely because of the price itself. Kind of related, like coal is still oversupplied globally. Coal prices are very cheap, and so you have the strong competition from there. To expand the use of natural gas in India, similarly in China, one area is very challenging, that is power generation, because there's competition is very, very strong. So that is so it's some of the issue is a contractual issue globally, outside, some of domestic pricing issue, and competition with coal, because not just gas, coal and other commodities also are pretty, the price declined. Except for oil, we already discussed. So oil is staying a little bit high on there, but other commodities are coming down. So that increasing the competition, even though the price is quite reasonable for spot LNG.
Okay. Now for 2019, what is your expectations of demand growth when it comes to Asia as a region, and which countries will contribute the most to this demand growth?
Well, for 2019 as a whole, obviously China will still add more demand. It's still the leader, and just last year they have so much increase in LNG imports, and this year it will still be positive growth in India, also adding more LNG. Long term, India has quite a bright future in terms of LNG imports, but particularly this year, so India and China are major sort of supporters of the regional growth, and Japan and Korea and Taiwan are more behind in terms of the growth. But overall, Asia will see more demand for this year, and for 2019, yeah. So China and India are the leaders, and for this growth.
Lastly, for 2019, when it comes to oil, what is the kind of demand projections that you are expecting for 2019, and which regions will lead this demand growth, at least for this current year, that is 2019?
Okay, I believe you talk about global and Asia. So globally, we see a weaker demand than last year, but we are still seeing all liquids inclusive. We call it oil liquids demand is about 1.4 million barrels per day growth for the whole year globally, with some kind of downside risk. The growth is out of that is around about 0.8 million barrels per day or 800,000 barrels per day coming from Asia. So Asia is still number one. And then U.S. still see more, and Middle East and some minor growth, Latin America and Africa. While the OECD country continue to see stagnation or decline. So we think Asia, you have three pillars: China, Southeast Asia, India. I should say China, India, Southeast Asia. All of these three pillars see some a little bit weaker, but China is the most reduction in growth this year. So China still contribute maybe 400,000 or 500,000 barrels per day, but compared to last year, is much lower. India maybe 200, and so altogether, Asia we're seeing about 800,000 barrels per day net growth of the oil demand this year, supporting the global demand growth.
Okay, that would be all, sir. Thank you for speaking to Bloomberg Quint.
Thank you very much for having me.